Hello value investors, thank you for joining me. Today I want to talk about my thought process when investing. This is going to be part of a series that I'm going to be running every Friday. Hopefully you'll find some ideas here over the next 3 or 4 minutes once a week that will help you become a more rounded investor. So in today's video we're going to talk about how to think about investing, whether you're a novice or intermediate or advanced, how many stocks you should own, and what you should not do when investing. So let's get started. The first thing to think when you're investing is you buying a portion of a business. This has really helped me out in many circumstances. The market is incredibly volatile right now, but it always goes through these kind of cycles. So it helps very much when you are buying a portion of the business to think like a business owner. The example I always give is about Apple. You might know everything there is to know about Apple, but until you own a share of Apple, you're not really thinking as a business owner. You're not really in your mind thinking, how does its services segment bounce off iPhone sales? You're not really thinking about those kind of things. Once you own a share of Apple, you start having a feel for those things. So that's my first bit of advice. The second bit of advice is how many stocks you need. So this is a very controversial topic. Many investors, when they're starting out, I would say you need at least 20 stocks. I do not think that you need a lot more than 20 stocks. I don't see any rationale for how your 21st idea is better than your first 1, 2, or 3 ideas. You don't want to be around 15 or 10 if you're just starting out, because that can be quite difficult. You may get a bit overwhelmed when things go a bit haywire. But as you've been investing for a longer period of time, you can be a little bit more aggressive. You can come down to like 14 or 12 or even 10 stocks. In the ideal scenario, you want to have enough of a position so if you're right, it can really make a big return on the overall portfolio. You don't want a really good idea to do really, really well and then it's a small portion and nothing really happens. Because what investing is quite a lot of to do with skill, but it's a lot to do with luck as well. You have no idea of what stock is going to do really well. You have absolutely no idea. You're trying to handicap these odds in your favor. You're looking for these asymmetric investments where you don't lose a lot when they go down, but you can do 2 or even 3x over 2 or 3 years when they go right, but you never know where they're going to come from. So you don't know the future. Nobody could have predicted the financial crisis. Nobody could have predicted that Greece was going to be default on their debt in 2012. No one could have predicted the coronavirus. Investing is really unpredictable, and there's going to be times when certain stocks should have been winners but they're not, and the times when stocks that are kind of lackluster actually turn out to be very strong performers. Next, the one thing you should not do in a sell-off is you should not sell. Do not sell into bad news. If the whole market is collapsing, more likely than not, investors are throwing the baby out to the bathwater. By that, I just mean that you need to have yourself a large margin of safety with possibly 6 months worth of cash that you can deal with some kind of emergency so that you're not a forced seller. You don't want to be in a position to be a forced seller. So no options, no leverage. You want to be in a position where you can hold on to your businesses and not have to be selling into the bad news. What's more, if you only have about 14 or 15 companies, you over time, if you hold them for a little bit of time, you kind of know the ins and outs of those businesses quite well. And you know what's good about them and you know what's bad about them. So when earnings disappoint, you can have more of a kind of clear mind about whether that's actually material or not to the overall thesis. So do not sell into bad news. And if the market is collapsing, that is not a reason for you to panic and sell out. Try and remember that markets have been through so much turmoil over the years. Even in the past 20 years, we had, the dot-com bust, we have all kinds of things, flash crashes of 2010, all kinds of things have been happening, and people got over it, and the market got over it, and the market is still going higher. So just taking that step back and have a bit more perspective, not to sell into a panic. So hope you found this video useful. As always, come over to my marketplace on Deep Value Returns. You're welcome to do a totally free trial to see if it suits you. 14 days, check it out. If it resonates with you, stick around. If it doesn't resonate with you, cancel, no harm, no foul. And I hope you found this video useful. Don't forget, check out my marketplace on Deep Value Returns. See you soon.